Hello. Can someone just, Mark, can you hear me, Mark?
I can
Yes,
hear
I can
you.
hear you.
Cool. Okay. I'll just let this gentleman sign in. Just give me another minute or so. Okay. Anyway, I'll just rock and roll. So I have a few things that I wanted to talk about today. So just a second, just to double check someone cannot sign in. Just apologies for this. Yeah, it's cool. Okay. So can see by the turnout that I feel that this is really apt at the moment to talk about this. So I'm going to kind of keep it short and sweet, but I hope that I deliver some value. It's quite difficult for me to think about different examples to help people remain investors. So the way I've tried to structure this is like this. So I was, if you play with an investment calculator, you can come up with all kinds of nonsense, right? And the way I was doing it is, okay, let's say that you have, let's say, 10K and you are investing at 15%. That's what I think is reasonable over the cycle to deliver. So that 10K, after 15 years, if you add $200 to it each month, it's 150K. And you might say, okay, you know what, 150K is not going to make or break me. And I recognize that, but I also believe that, depending where you are on this kind of investment journey, you might not be starting with 10K. You maybe have a bit more. Or conversely, you have a longer runway. If you're, let's say, 40 and you might not be wanting to retire at 55. So it's kind of like, these numbers don't mean a lot. But rather than thinking about what the absolute number is, what about reversing it and say, okay, is there any other way that I'm going to show up in my house with 150K? I don't hear anyone knocking on my door here, giving me a check and say, hey, Michael, here's 150K. So I'm just thinking myself, okay, yeah, on the one hand, it doesn't sound like a lot. And then on the other hand, I think myself, okay, there's no other scenario. It's like the Vikings kind of go in and invading some island and they burning the ships. If you think like that there is no alternative, I believe this is quite helpful. At least it is for me. I like to think about investing. A lot of the times I kind of come on here and it's, the market is so excited and everyone is excited. And I'm like, yeah, it's kind of like, I don't feel like I'm providing anything. But times like right now, when things are taking a breather, I'm like, yeah, I feel that this is the time when it makes the difference. I genuinely believe that. And the problem with investing, the problem is that it's difficult to remain focused. Everyone wants that kind of outperformance. Everyone wants those strong returns. But those strong returns come at a cost, right? You need to partially be on your feet, focus somewhat, and also you need to be in kind of something that's slightly more untested and slightly more volatile. So, every other year, like it happened at Berkshire this year, someone asks, oh, Warren, you said that you're going to compound at 50%. How would you do it? And he says, oh, I would kind of go off on some kind of a less followed companies. And he kind of talks about, Warren always tells a little story to kind of make it just to carry some more value. And the story that he talks about is how when he met Charlie, he knew about this kind of railway that had some preferred shares in like California or something. And Charlie thought that he was the only person on the planet that knew about this. And they kind of had a little bit of a joke about this, that who in the right mind would know about this, this discrepancy. So I don't know how that investment turned out. Obviously, we're talking, easily like 70 years ago. But the point of the matter is that irrespective of how that those preferred shares from that railway company turned out, I believe it would have been really, really volatile. It wouldn't be just that Warren shows up, signs this, puts his name on the stamp, and the things reprice higher. It would have been gut wrenching, and the same for everything else. And I didn't write this on my notes, but I feel that this is important, particularly right now when the markets are so shaky. I feel that this message is important. So Warren obviously has an unblemished track record. But, there are plenty of investors that have had a bit of a difficult period and had to kind of be born again kind of thing, right? So in my mind, I'm thinking here like how Ben Graham was. Obviously, this is Ben Graham, and it's like, oh, before the depression, but the story stands. He was using leverage, and he was kind of optimizing his investment strategy, and he was up a lot in 1929, and then in 1930, things just implode, and 1931, they implode further. And him going through that period was what kind of redesigned his strategy. So he had to go through that gut-wrenching period. And I believe that this resonates a lot with, what I'm trying to do. I had this vision in 2022 about these things that I had, and it didn't work out. And I had to go through that very ugly period. And I find that a lot of these professions where someone wants to really do something significant, it's only when you're at the bottom of the pit that you figure out what you really want to do with your life, because that's like the world kind of testing you. There's I think there's a quote from Oprah. I'm butchering the quote here, but it's like when you're kind of at the bottom and you're getting hit, life is just kind of slapping you in the face and kind of saying, do you actually want this? Is this really what you want? And if you kind of keep standing up, after a while, life kind of gets in the way. It's like, man, this loser, like let him just go and do his thing. I'll go on to the next loser. And you have to go through these periods that are difficult to figure out a couple of things. And I find that in investing, it's so tricky because it plays on your mind a lot. When things are performing strongly, you take the foot off the gas, you kind of, you let your guard go off slightly, and you believe the narratives and you believe your own BS. And we kid ourselves. And we are so easy to kid. My God, we're so easy to kid. And we just kind of buy our own garbage that we kind of put out there. So that's why I'm quite brutal in terms of, I want to get out of an investment, and once it kind of I feel like it hit what I believe is my fair value, and I don't want to hang around because I have seen these things round trip. I've seen them. And nobody wrote to me to say, oh, this thing is going to round trip. It kind of comes down a little bit, and it's like, okay, I'm cool. I'm kind of like, and I kind of average in, and I'm cool, I got this. And then it kind of dips down a little bit on the back of earnings. And I'm like, okay, like, what shall I do? Kind of like that. And I don't want to be like that, there's another quote that I kind of don't remember how it goes. Something like, you can either sell into strength or be a forced seller into weakness, because you can't time these things, right? You can time the stock that you're going to buy. You can time that, right? I'm going to buy it today, let's say, but it's quite difficult to time the exit. So you have to come in with a plan. This is the plan I'm going to go with. And you have to be quite hard on yourself and make tough decisions. Now, this is kind of difficult for me saying this, because I kind of wanted to, I wanted to keep hims and hers a bit longer. And I kind of, I've always said, $20, man, I'm getting out of this, man, because I've been with this for so long. And I've seen so many times my hims stock blow up 50% while I've held it. I've seen it so many times, man. I've lost count. And it's been 3 years, man. I've seen this thing fall below $4. Not that I didn't buy below, but I did buy it once at approximately $4, $4.79. Now I've seen it. I've seen it blow up. I've seen it blow up. I've seen it. So I don't want to hang around and see it blow up again, because now it's reasonable money. I'm kind of it's kind of fair game. I kind of I can find something else. I don't want to play a hero. I don't need to prove anything to anybody. But this is my ego speaking, because I have been through these situations. I built up that experience where I've seen these stocks blow up. Okay. Now, if I take that experience into my position, I have to stop and think myself, does the investor that come next year, do they care that Michael's seen this blow up 50%? They don't give a rat's ass about me. They're thinking about their own journey. So when I looked at hims and hers, and I've been following this company for a long time now, and these guys, I don't know, I can't explain it, but they put out a target. To my knowledge, let me just think this through. It might not be 100% accurate to this, but okay, it's not 100% accurate, but to my knowledge, it's one of the few companies that I remember that came out of a SPAC with that kind of investor presentation that they all had at the time, and they had like the 3-year revenue. And to my knowledge, I feel that they're the only people. No, there might be someone else, I think, along the way. But it's one of the few companies that actually met that little presentation. And not only met, continuously beat, raise. And they've been doing this and doing this and doing this. And I'm like, okay, but the market had never been giving it its fair value. And I recognize why. It's easy to see why. They sell, sildenafil, Viagra, and heparins. Okay, so it's high churn. You can get that stuff elsewhere. So I recognize why the market is so dubious. I get that. It's not difficult to recognize that. But I didn't feel that it would be a fair value when it was around $10. I was like, I feel like it could do more. And it was kind of hovering around $16, and then kind of this news broke out all over Twitter about this GLP-1, and it kind of went to like $20, and then it came back down again, once again. And I think myself, okay, I'm wanting to call the brakes on this, because I don't want to give up anymore. I've been through this. I've seen the pain. I want out. But then I mean, okay, you know what? This whole new revenue stream has come out of somewhere. And it's not that they're kind of reinventing the wheel, because for me, I believe that a business, the most difficult thing that a business has to do is acquire a customer. And not just any customer, a customer that's willing to put down their credit card details or so, whatever, it's similar, to pay for something. You can get many customers, like Coca-Cola has a lot of customers. But to get somebody to actually pay for something is a whole different matter. And I estimate that at the end of this year, they're going to have 2 million paying subscribers. Obviously, some of those churn out. I recognize that. But at the end of this day, you have 2 million people paying at the end of each month, paying to be on the platform, getting some kind of stuff, whatever it may be. 2 million is a lot of people. And I think I was okay, imagine that Coca-Cola had access to the bank account details of 2 million customers. That'd be pretty fantastic. So I mean myself, they have a connection, a brand. Now, let me just be clear. The way that I invest, I have no interest in this kind of narrative BS. I care about the free cash flow. I like narratives come, narratives go, a brand value, moat, all this is nonsense. I've seen enough to know that this is all nonsense. But at the end of the day, they do have these 2 million people, and maybe some of them wouldn't mind to get hold of these GLP-1 drugs. So you get a new revenue stream kind of coming out of nowhere that the business has no debt and they're already making substantial free cash flow. So they're already self-sufficient. So you can just take that free cash flow and reinvest it in this new revenue stream, and maybe there's some more upside coming. Now, obviously, here's the problem already. The problem here is that if they take some of that profitability that they're growing at now to reinvest in the business, they will not be as profitable next year as it would have seemed if that other business didn't show up. But then you're going to have a lot more revenues coming in. And I know that the market loves a growth story. The market loves a growth story. So I don't want to punish the upside on the stock simply because of where I've come from, because nobody cares about that. And I'm just going to say one more thing, because this question came in from, oh, sorry, before I talk about that. So, I wanted to talk one more thing briefly, very quickly. So, I apologize. I'm reading a Buffett quote, and I read it like 2 weeks ago when I was on the call, and I said, oh my God, I don't want to lean on Buffett to kind of validate what I'm trying to do. And I apologize, I'm doing it again. So I apologize for that. But he says, if you remove the 15 or so most important decisions we've made over the past years, our record is pretty mediocre. And that's the thing. In the ideal situation, you have 20 stocks in your portfolio, and all of those 20 go up neatly over 15%, and that's it. You're a hero, everyone's singing hosannas. But that's not reality. You're going to have a few good picks and a lot of crap and some junk. And that's the reality of the situation. So I wish that it was easy, this thing, that I could just kind of say, okay, go with Aus, go with Sezzle, go with AppLovin, whatever, and that would all just kind of go 15%. But some do better than others, and that's the reality of it. And it's difficult. And a lot of people struggle with this. I see that Daniel's kind of shaking his head like he probably like he gets it, but not everybody gets it. And it's a simple concept, but it's like not everything is going to work out. You're going to have some good ideas and a lot of junk. And that's the reality. Now, this question came from Vasilis, and he very kindly wrote to me this question about AppLovin. And thank you so much for doing that. So essentially, the question is how to figure out what the fair value of AppLovin is, considering that it has quite a lot of debt. What's a reasonable amount of debt? It does have a lot of debt. And every time that I tell you about an investment, I think about this. If you don't understand where the company's balance sheet is, ask me, I can help you with that. And if you can't, if you want to look at it yourself, just look at how much debt it has and look at how much free cash flow it has. Now, generally speaking, the market doesn't reward companies that acquire other companies very highly. An example of this could be, like Cisco. An example of this could be, Salesforce, kind of very acquisitive. The market doesn't like that kind of stuff. The market likes organic growth, because they want to know that your product is worthwhile. And right now, at this moment in time, AppLovin's debt is not the critical issue. I believe, in my opinion, once that free cash flow times 3, if it's times 3 is if the free cash flow times 3 is greater than the amount of debt, that's fine. That means the company could pay back their debt in 3 years, which in the case of AppLovin is true. And that's all hunky-dory. So I like this rule of thumb of 3 times the free cash flow. If it's 3 times the free cash flow is higher than the debt, we're all good, everyone's singing and dancing. The problem with AppLovin is that it's an advertising business. And I know this is going to be, depends on what share price you bought AppLovin, this kind of resonates or doesn't resonate with you. But advertising businesses are brutal. Are brutal businesses. I've seen them implode time and time again. I saw one now they kind of, I don't remember what the latest name, this one company, it was a British company, kind of changed their name every like 2 weeks. I think the latest was they called Tremor, but I can't remember if they called Tremor now. Like they change their name every week. Obviously, the classic example of this is a Digital Turbine, which also has the ticker UPS with an S on the end. This was like an untouchable business. And then it kind of like, it's like, this thing totally imploded. So these advertising businesses, and if you want to cross-reference this, you can look, for example, to Snap, the social media company. Like they get a lot of revenue in and everything is like revenue growth rates are going really strong, and then all of a sudden something happens and it just kind of puts the brakes and this just all kind of melts away. You can look at Magnite, you can look at Pubmatic. There was one called I think it was French, Criterio or Criterion or something. I can't remember what it's called. I've seen this happen so many times that these businesses look like they're just growing and they're like to the sky, and they just melt away real quick. Now, I don't believe that right now AppLovin is overvalued by any stretch, but I am thinking about the exits. I'm very much thinking like hopefully before that Q2 result comes out in the summer, I don't want to take the risk going into that, because the outlook now is just immaculate. The outlook is so beautiful, man. It's like everything is swimming for this. It's like they have the software business that's growing really fast and the margins are exceedingly high, and anything like the valuation doesn't look crazy optically. But I also know that these advertising companies, if you look back when it was COVID and with Google, it just kind of really out of nowhere, the share price kind of starts reacting before even the valuation or even the fundamentals have any reason to kind of come down, and they just melt away. So this is an example of a company that I like very much, but it's hot. It's a hot company. Everyone on Twitter is talking about it, and I kind of have to be very prudent here. So I tried to give two examples, one with Hims and one with AppLovin, where I've tried to add some nuance, where I have broken my rules to extend the time horizon with Hims, and I've kind of felt, okay, no, with AppLovin, I feel that's as good as probably going to get for me. It might continue to go and be very successful, and I hope it does. I enjoy listening to the CEO. He seems to be cool. I mean, a lot of these CEOs are cool, so that's not says a lot. But there's some less cool people. But anyway, so I wish them all the best. But that'll be that. Okay, I've waffled on for too long. I apologize for that. So if anyone wants to kind of ask any questions, this is a good time. Mark, if you want to ask me any question about Hims, I am ready for you as well.
I actually wanted to ask you about Palantir.
Yeah.
You look at your target and where the price is now. If you look at Hoods and Hims, the targets on all three of those are like 30.
Mm-hmm.
What would Palantir have to do before you'd put it off a hold and on a buy?
Yeah, so what I'm looking for is I'm trying my best to look at the results. So it's really the earnings results that I'm going to look at. When those results come in, they need to, I'll be honest, I'm just looking for them to actually have a bit more revenue growth, because I know that they really make a ton of free cash flow. But that's a tricky business. You see what they do very well, is they charge a lot for their product, but it's a very small pool that they're working off, like governments and stuff like that. It's not a very large total addressable market. Irrespective of what they say, they will talk, whatever, let them talk. But ultimately, they charge a lot for their product, and they're not doing anything that is particularly like unheard of. So it's, they need to have some more growth coming in. Ideally, I would like to see, 20, I mean, I would like to see a little bit above 20% on the cards. And if it's not, I'm kind of, you see, this is a good example, Mark, because when I bought Palente, again, we're talking about like your experience that you have, right? So I had a chance to call it a day, but I believed that it had some more upside. And in hindsight, I should have called it a day, and I could have just, called it a day, hit my target, and rock and roll. But the fact of the matter was that I felt, man, this free cash flow is really strong. When I first recommended Palantir, I was thinking, okay, maybe they'll make around 700 million of free cash flow at some point. That was what I was thinking. And now they're making $1 billion. So, and the share price hasn't really reflected that. So I'm kind of, okay, I feel that people are punishing this a bit somewhat. But I'll add another thing that I'm quite excited, why I like Palantir, because their customer is like the US government. And even if you look at other software in the last couple of weeks has really sold off. A lot of these software companies have kind of sold off quite a lot, but Palantir's kind of remained quite like stable, hasn't really sold off to the same level. And I believe that's the market saying, okay, their customer, the US government, and in the UK, the NHS, they're going to pay no matter what. So it's kind of like, it's not going to be sold off as aggressively. So for me, that's important as well, because, I'm thinking about my performance. But ultimately, I want to see something exceptional to kind of say to people, okay, let's buy some more here. And I need that risk reward to be like, I need to believe it. You know what I mean? Because I feel responsibility for this. And, when I recommend something, I wanted to believe in it so much that when I do see it fall off 50%, as it happens quite often, I need to be cool, calm, and collected. I don't want to have any doubts. So I've got a couple of minutes. I'll just talk about a company that a few people have reached out to me about. This Alarm Technologies, maybe you've heard, ALAR. A lot of people have written to me about this. And I look at this, and the financials are beautiful. Like, the problem is, it's a small cap. And those small caps, when you're working off small numbers, you can have some really fast growth rate, and it looks amazing. But when those numbers don't look as amazing, the share price is down, I don't want to be nervous. I want to know that what I recommended, I can stand by. And so with Palantir, I feel confident that, it could in time reach 30. So I'm quite confident there. But for me to make it a real kind of strong buy, I want to see that 20% growth rates could be on the card. Did that answer your question?
Yes, it does. A company you were thinking of was Criteo
Oh, thank you so much. Thank you.
years ago.
Are they French? I think, were they French?
Yes, yes. Ours, I think.
Michael, I had a question. If I was hoping you could just kind of touch base one on Sentinel-1, and then also just kind of give us your philosophy on like short interest. Do you pay attention to that? I know GigaCloud technology was having an increased short interest. So like, do you respond at all to that, or is that
I'll
just
take the easy
noise?
I'll take the easy one. The short interest makes no difference. Absolutely no difference, man. I've seen Tesla have a short interest since the dawn of time. And that hasn't stopped it getting to $1 trillion market cap. So short interest is the complete nonsense. No, I don't pay attention to that. And, I made free stocks, like my kind of, I run this competition in Switzerland, and I made free stocks, my kind of buy and hold for 5 years in this competition. And I put a GigaCloud, and I put Moneyline, and I put Sentinel-1. And Sentinel-1 is dragging down the performance of the other two. And it frustrates me like mad. But if I'm honest about this, there are two real legit cyber companies. There's CrowdStrike and there's Sentinel-1. Those are like the kind of the best of the best. Zscaler, is okay, and Okta is okay, but I don't believe that they're on the same league. I don't believe. Okay, but we can push this aside, that's because they do different things. But Sentinel-1 is, to my knowledge, without any heroics, like just speaking frankly, they'll be growing next year at 30%, and they're going to be slightly profitable at some point. Hopefully, fingers crossed, they might reach profitability at the end of this year, but certainly next year they're going to be profitable. they improved their profitability from negative, I think it was negative 38% non-GAAP, negative 38 to negative 6. That's like in 12 months. That's like mad. We are having to sacrifice too much of their top line. Like I've been investing for quite a while. I haven't seen those level of jumps. So, and they haven't sacrificed too much of the top line. So they've been able to cut out loads of costs. Now, the market obviously punished them because they did lose some top line. And, the market with growth stocks is really, the blood of the growth company is growth. Everything else is noise. You need to deliver growth. And they did pull back on their guidance. And I get it. But my thesis is never about the growth rate because the growth rate is still really, really strong. My thesis was, can they reach break even / some profitability? So that's still intact. In fact, it may, we'll see. I didn't write about this, but it may have been kind of pulled forward by a quarter. So like in 2 quarters, they might already be there. So my thesis is working. Now, obviously, my thesis wasn't the market's thesis, and it's brutal. Now, I'll just caveat one thing. When people talk about investing, they spin whatever story they want to spin. And I'm guilty, and I apologize for that. But when Sentinel-1 reported and it came into the open, the share price was down negative 22 on a very bloody day. It ended the day at a minus 15. So it kind of came back up. And today, before I came on the call, all coming back up again. So like there was kind of getting out some weak hands. And that's why I don't like to, I hate using stop losses, because with stop losses, I'll be all nervous. Do I get back in now? Do I wait for a better time? And for me, going from, let's say, negative 22 to like now, as I speak, is about, let's say, from the bottom would be, let's say, I don't know, about exaggerating, around, like, say, negative 10. That's 12% return. That's a very good return in 2 days. So I feel like if I had a stop loss, I would have missed out on that. So yeah, I would have felt good about myself that I wasn't sucker punched. But on the other side, man, 12% in a couple of days is nothing to sneer at. So I believe I believe very much that I'm right there. But I have made mistakes before, and I make mistakes all the time. And it's easy for me to double down in my thesis, commitment and consistency biases. But I'm trying to be transparent. I'm trying to say, listen, this is what I think. Mm-hmm. I have made mistakes, but I genuinely feel that if I compare with these other cybersecurity companies, they're not doing so much worse than, let's say, CrowdStrike was doing about 3 years ago. So, the market now gives CrowdStrike the pass, but there was a period where in 2022, where it wasn't getting the pass and Palo Alto was getting the pass. So, the market gives a pass from time to time to different stocks. So you can't really play that game all the time. You need to kind of have some conviction in what you're trying to do.
That's great. Thanks for the clarification.
Do you think that some of this, when they come out with earnings, like Sentinel-1, that they run that language through an algorithm, and some of those sell-offs are the results of an algorithm? And
I think that's a well-known fact. Yes, for sure. I think that's yeah.
So then the people who look at that have a brain and think, say, I'm going to get back in afterwards, after the sell-off.
Well, that's the hypothesis. There was a quote from when Ben Graham was in front of the Senate. I don't know the year of the quote, whatever. It was like, you can look this up, but basically the Senate said, oh, what causes stocks to get repriced closer to intrinsic value? And he said, well, I don't really know. It's not that we write to something. The market just has a way of kind of figuring out the value of stuff. And this was, I think, was in the ballpark of, like, let's say 1950s or something, that he said that in front of the Senate in the US. So, even in those days, before computers, the market kind of has a way of figuring things out. So, people do think the market will go to where the intrinsic value is. Whether you calculate the intrinsic value right or wrong, that's a different question. But the market is quite good at figuring things out. Okay. If you haven't got any more questions, do you have any more questions for today? Thank you so much, everybody.
Thanks, Mike.
Thank you so much, and thank you very much. And I hope to see you next Tuesday. Hopefully by next Tuesday, the market will be more exciting and be more people on the call. And yeah, and I'd like to thank you all. Thank you.
Thank you. Thank you.
Bye.
Thank you.